understanding the basics of financial markets. Do you feel lost when you hear terms like stocks, forex, or crypto? You're not alone. Understanding how financial markets work is crucial to making informed decisions and becoming a successful trader. Welcome back to the Vienna Online Trading Hub. I'm Happy Kpor, and today we're addressing a common problem among beginner traders, a lack of knowledge about how the markets work. If you're confused about where to start, which market to focus on, or what all these terms mean, this video is for you. Don't forget to hit that like button, subscribe, and turn on notifications so you never miss out on our helpful trading tips. By the end of this session, you'll understand not only the basics of financial markets, but also how they connect to opportunities you can explore for your financial growth. So grab a notebook and let's dive in. Let's start with the fundamentals. What exactly do we mean by financial markets? In simple terms, financial markets are platforms or systems where individuals and organizations can buy, sell, or trade financial assets. These assets might include stocks, bonds, currencies, commodities, and more. Think of a financial market as the marketplace for the economy, a hub where buyers and sellers come together to exchange these assets. Why are financial markets important? They play a crucial role in the global economy by ensuring two primary things. One, providing businesses with the capital they need to grow, and two, allowing individuals to invest and build wealth over time. In short, they are the beating heart of economic activity worldwide. Imagine this scenario. If a company needs money to expand, it can issue shares or bonds in a financial market. Investors then buy those shares or bonds in exchange for returns. This interaction creates opportunities for growth, not just for businesses, but also for individuals looking to invest their money effectively. Now that we know what financial markets are, let's break them down into two main types. Capital markets are where long-term financial securities like stocks and bonds are traded. If you've heard of the stock market, you're already familiar with one part of capital markets. Companies use this platform to raise funds from investors by selling shares or issuing bonds. For example, when you buy a company's stock, you're essentially purchasing a small ownership stake in that company. Bonds, on the other hand, are like loans that you, the investor, provide to businesses or governments. In return, you receive periodic interest payments along with your original investment at the end of the bond term. Money markets are designed for shorter-term financial instruments, typically with a duration of 1 year or less. Examples include treasury bills, certificates of deposit, CDs, and commercial paper. These tools are often used by governments, banks, or corporations to manage short-term cash needs. Capital markets focus on building assets over the long haul, while money markets are geared toward immediate short-term liquidity. Understanding this distinction is key to navigating the financial market space. Now let's talk about the main players in financial markets. These participants work together to keep the system functioning smoothly. People like you and me fall into this category. Individual investors use financial markets to invest their money, grow wealth, and meet financial goals like saving for retirement or buying a home. Traders, on the other hand, actively buy and sell assets to make short-term profits. These are larger organizations such as banks, mutual funds, pension funds, and hedge funds. They operate on a much bigger scale, trading millions or even billions of dollars in assets to generate returns for their clients or shareholders. Governments use financial markets to issue bonds to raise money for infrastructure projects and public programs. Companies, meanwhile, use markets to raise capital for growth by selling stocks or bonds to investors. All these players interact within the market, creating a system where capital flows efficiently, enabling economic growth. At their core, financial markets operate based on the age-old principles of supply and demand. Here's how it works. Imagine you want to buy a share of stock. You need a willing seller, right? When many buyers outnumber sellers for a specific stock, the price goes up because demand exceeds supply. Conversely, if there are more sellers than buyers, the price falls. This dynamic is what drives fluctuations in asset prices. But how do you connect with buyers or sellers? That's where intermediaries like brokers and exchanges come in. Brokers act as middlemen, linking you to other participants in the market. Stock exchanges like the New York Stock Exchange, NYSE, or NASDAQ are centralized systems where thousands of these trades happen every second. This entire process ensures that markets remain liquid, meaning it's easy to buy or sell assets whenever you need to. To better understand how financial markets function, let's explore some of their most important components. Stocks represent a share in the ownership of a company. When you purchase stock, you become part owner of that business. Stocks can rise or fall in value based on the company's performance and broader market trends. Bonds are fixed income securities where you lend money to a borrower, often a company or government, in exchange for periodic interest payments. Bonds are generally considered safer than stocks, but also tend to offer lower returns. This category includes physical goods like oil, gold, agricultural products, and more. Commodities are traded on specialized markets, and their prices are influenced by supply, demand, and geopolitical events. Indices like the S&P 500 or Dow Jones measure the performance of a group of stocks or other securities. They provide a snapshot of how a particular segment of the financial market is performing overall. Each of these components plays a unique role in the financial system. One of the reasons financial markets can function smoothly is regulation. Regulations ensure markets are fair, efficient, and transparent, so all participants are treated equally. In many countries, regulatory bodies like the U.S. Securities and Exchange Commission, SEC, oversee financial markets. Their job is to monitor trades, prevent fraud, and protect investors from unethical practices. Without regulations, markets could become chaotic, leaving traders vulnerable to scams and market manipulation. Regulation is essentially a safety net helping to level the playing field for everyone. Financial markets bring tremendous benefits, but they aren't without risks. Let's weigh both sides. Wealth building. Markets give investors the chance to grow their money over time. 2. Capital raising. Businesses can secure funds for expansion or innovation. 3. Risk management. Tools like futures and options help organizations manage financial risks. Volatility. Markets can be unpredictable, with prices rising or falling sharply. Losses. Investments don't always go as planned, leading to potential financial setbacks. 3. Complexity. The sheer variety of financial instruments and strategies can be overwhelming for beginners. While the rewards can be great, it's important to approach financial markets with caution and a solid understanding of the risks involved. To make things more relatable, let's look at a couple of real-world scenarios. Imagine a company called Teknova going public by offering shares for sale in the stock market. If you buy one of those shares, you own a small piece of Teknova. If the company grows and its profits increase, the value of your stock likely goes up too. On the flip side, if Teknova faces challenges, its stock price may drop. Or consider the government issuing bonds to fund a new highway project. By purchasing one of these bonds, you're essentially lending money to the government, which it will repay with interest. These examples show how financial markets create opportunities for wealth generation, while also serving broader societal needs. We've covered a lot today. Here's a quick summary of the key points. Financial markets are platforms where assets like stocks, bonds, and commodities are traded. There are two main markets: capital markets for long-term securities and money markets for short-term instruments. Key players include individuals, institutional investors, governments, and companies. Markets operate on supply-demand dynamics, connecting buyers and sellers seamlessly through intermediaries. 5. Stocks, bonds, and commodities are major components of financial markets, each with unique characteristics and roles. Regulation ensures fairness, transparency, and protection for investors. 7. While financial markets offer significant benefits, they also carry risks like volatility and potential losses. With a solid understanding of these basics, you've taken the first step toward becoming an informed trader or investor. Financial markets are vast and complex, but they're also one of the most thrilling aspects of the global economy. By grasping these foundational concepts, you're better equipped to explore the opportunities they hold. Remember, the journey toward understanding finance doesn't stop here. Continue learning, stay curious, and take measured steps as you dive deeper into this dynamic world. Thank you for joining us today. We hope this breakdown inspires you to explore financial markets with confidence.